If you have $500 a month sitting in your account and you are not sure what to do with it, this might be the most important information you digest this year. That single number is the exact line separating most Australians who retire stressed from the ones who retire completely free. The problem is that almost nobody walks you through what that amount actually becomes over time. They show you fancy charts and vague promises, but they never sit down to run the real math for an Aussie investing inside the Australian financial system. Let us start with an uncomfortable reality. The average Australian aged 30 to 34 has under $50,000 in their superannuation. By their early 50s, that average balance sits around $200,000. By the time most Aussies hit retirement, they're left with a balance that runs out within 10 to 12 years. This is not a money problem, it's a math problem that people never had explained to them. If you truly understood what $500 a month does over time, you would never let another payday pass without sending that money to work. The engine behind everything is compound growth. It's not magic, it's just math. However, it behaves like magic because numbers do not move in a straight line. They curve upward, and the longer you stay invested, the steeper that curve gets. The Australian share market has averaged around 9 to 10% per year over the last 30 years, including dividends. Balanced super funds have averaged about 8% per year over the last decade. Using a conservative, realistic blended return of 8% based on actual Australian fund deliveries, let us run the numbers. If you invest $500 every single month, earning 8% per year, after 10 years, you have put in $60,000 of your own money. Your balance, however, is sitting at roughly $91,500. Most people see that and shrug. They think it's nice, but not life-changing. They're right, because 10 years is just the warm-up. The real shift happens next. Fast forward to 20 years of the exact same contribution and return. You have now contributed $120,000 of your own money, but your balance has climbed to around $294,500. This 20-year mark is the moment most Australians never reach. Somewhere between year 4 and year 7, life happens. A wedding, a renovation, a car upgrade, or a bad month at work interrupts the flow, and people pause their contributions or pull the money out. Every time someone does that, they don't just lose the cash, they lose the next 20 years of compounding growth that money was about to produce. Now look at the 30-year mark. Your total personal contributions hit $180,000, but your balance is approximately $745,000. That's nearly $750,000 from a single decision you made and never reversed. If the return runs closer to the long-term historical average of 10%, that same $500 a month becomes over $1.1 million. This comes from an amount you probably already spend on things you can't remember buying. In fact, the last 10 years of that 30-year journey produce more wealth than the first 20 years combined. $500 a month breaks down to roughly $16.50 a day. That's the cost of a daily takeaway coffee and a quick snack, or a single delivery food order. Most Australians are not broke, they're just unfocused. The money is leaving the account every week anyway. The question is whether it's leaving toward your future or toward someone else's profit margin. Inside Australia, you have 3 main paths to execute this. The first is salary sacrificing into superannuation. If you earn $80,000 a year and salary sacrifice $500 a month, you cut your taxable income, pay only 15% contributions tax instead of your higher marginal rate, and the money grows in a low-tax environment. The second path is low-cost exchange-traded funds, or ETFs, through a brokerage account. These broad index funds cover the local share market and global shares with tiny fees. This method keeps your money liquid so you can access it before age 60, though you'll pay tax on dividends and capital gains at your marginal rate. The third option is a hybrid approach, splitting the money between super for the tax break and ETFs for earlier flexibility. The reason most people fail to build wealth is that they treat investing as a brand new decision they have to make every single month. Every month, a different expense feels more urgent, so the money never moves. The investors who win are not the smartest or the highest earners. They're the ones who automate the transfer for the day after payday and refuse to interrupt the compounding process. Where is your $500 a month going right now? If you can't name its destination, the money is just disappearing, and you're missing out on the only true edge a regular investor has: time and consistency.